Hello all, welcome to today's session regarding income tax of capital gains. My name is C.A. Shoikatroy and today I have been joined by Rahul, who's my colleague. Rahul is a qualified professional with a experience in taxation field for a period of 4.5 years. Myself, uh, I myself am working with clear tax for past 4.5 years as well, and my area of expertise lies in income tax and international taxation. Now, let's take a look at what shall be the topic of discussion today. Firstly, we are going to discuss a little bit about income tax document preparation, and later point of time we are going to go through the various aspects of capital gains. Now, there it's going to be a very interesting discussion. Hope you can stick with us and learn something that can help you file the income tax return. Now, the purpose behind choosing capital gains is in the last few years we have seen a huge influx in the number of retail investor. So we thought it would be pertinent to address the taxation queries people who are making capital gains or capital losses for that matter. Now, firstly, we are going to talk a little bit about documents that need to be kept in handy to file the income tax return. We are in the middle of income tax proof submission window. All the organization they have opened up the window, they are collecting the documents, the proof, so that they can compute the taxes and withhold the taxes. Now there is a possibility that you may have already missed the window, or you are going to invest in couple of months time because the financial year has not ended yet. To prepare yourself for income tax return filing process in the month of June and July, we thought it would be a good idea to give you a little heads up on what sort of documents you should be keeping in handy. Firstly, if you have missed the proof submission window, in that case, there will be a situation wherein your employer will be deducting a higher rate of taxes, right? So, uh, because you have declared a certain investment at the beginning of the year, however, you did not submit the proof. But the world does not end there. You still have the option to declare all these investment at the time of filing your income tax return. Right? All you have to do is maintain all the documents. For example, if you are investing in ELSS, so most definitely there will be a receipt for the investment. If you are investing in LIC, life insurance policy, or medical insurance policy, in that case, you will be having a premium receipt. So, all these documents will come in handy at the time of filing your income tax return. Also, if you have missed declaring the HRA component, right? So, you are supposed to submit the rent receipt or the rental agreement, whichever is necessary. However, you miss that opportunity. So, in that case, you can save those documents, the rent receipt, the rental agreement, with the help of that, and with the help of the pay slips that you have, we can calculate the HRA amount and claim that amount in the income tax return. Therefore, it is pertinent to note that if you have missed all the income declaration, tax declaration, proof submission, you can do so at the time of filing your income tax return. Now, tax will be deducted a bit higher in these 2 3 months. However, when you have all the correct information, when you provide all the correct information, the excess amount of tax, if it has been deducted, will be given back to you as refund once the return is filed and it has been processed. Now, uh, let's take a look at capital asset. Now, we are moving to today's main topic, right? So, first, before going into the understanding of taxation aspect of profit, let's try to understand what is a capital asset. Now, capital asset has been described as any property held of any kind by any person, right? However, it does not include any items held for personal usage. For example, if you have a mobile phone, right? If you have a mobile phone, you will be using it for your personal purpose. And after 2 years of using, if you are selling it off to buy a new mobile phone, it will not give you a capital asset. Same situation applies to car, motorbike, clothing, etc. as well. However, there are certain items which can be treated as capital asset. For example, shares, gold jewelries, right? Or any jewelry for that matter. Any work of art, archaeological items. Those items are actually considered to be a capital asset. Now, so if we summarize, then capital asset means a property held by a person of any kind, which may include land, building, jewelry, work of art, shares, mutual fund units, securities, bond, debentures, etc., etc. Now, having understood capital asset, let's try to understand when the capital gain arises. Now, the basic premise of capital gains is when you transfer the capital asset to any other person for a consideration, in that extent, in that moment, the transfer of capital gains happens or transfer actually happens. And if you make any sum by the transfer, because of the transfer that you are making, in that case, whatever gain that you are making, that becomes capital gains. Now, this transfer can be of many kind. It can be sale or exchange. It can be extinguishment of right. It can be redemption or maturity. Now, sale, it is pretty much simple to understand. If you are a owner of an asset, you are transferring that asset in exchange of money, right? So that is sell, and if you are making the sell, most definitely there will be a transfer. If you are exchanging the asset, say for example, I have a flat in Bangalore, right? Now I am exchanging that flat in Bangalore for a flat located in Delhi. In that case, if I make more money, right? For example, the market price of the flat located in Delhi is 1 CR, and the market price of the flat located in Bangalore is 90 lakhs. So in that case, I am making a gain of 10 lakhs. So these 10 lakh rupees will be my capital gains. Thirdly, relinquishment of any asset. For example, I have a piece of land, right? I own that piece of land. Now I am relinquishing my right. I am withdrawing my right from the land in favor of government, right? Because the government wants to build a road or something in that piece of land. In that case, relinquishment of right happens, and if that happens, it actually constitutes transfer. Now, the taxability of that we will come to later, but uh, if you are extinguishing right, if you are withdrawing your right from any asset, that becomes a transfer as well. Right? Now, maturity or redemption. There are certain bonds which has a maturity term attached to it. It may be 5 years, 10 years, 15 years, whatever it may be. Now, at the time of maturity, you get some money. Mostly it happens in case of deep discount bonds. Now, at the time of its maturity, whatever gains you are making, that becomes your capital gains. Now, having understood uh, what constitutes a transfer and what is a capital asset, let's come to a really very important concept in respect of capital gains, that is a holding period. Now, the holding period of an asset is of utmost importance. Why? Because based on the holding period of an asset, uh, we usually determine whether it will be a long-term capital gains or a short. Sorry for the technical inconvenience. Now, as I was saying, sorry for the technical inconvenience. Now, as I was saying, right. So the holding period, it is a very important nature because depending on the holding period, it makes a capital gains either in long term or a short term. And the rate of taxation and the treatment of calculation of these long term and short term capital gains are vastly different. Therefore, it is very important to understand what is a holding period of an asset. That means for how long I need to hold a particular class of asset so it becomes a long term asset. Right? Normal terms, if I'm holding any asset for a period more than 36 months, it will be treated as long term asset, right? If I am holding a asset for a period in excess of 36 months, it becomes a long term asset, and whatever gains that I am making from it on transfer, that becomes my long term capital gains. However, there are certain exceptions to it, right? For example, listed equity shares and equity linked mutual funds, right? They have a special holding period attached to it, right? If listed shares or listed equity oriented mutual fund, these two classes, if are held for a period more than 12 months, in that case, they become long term capital asset. If listed shares and equity mutual funds are held for a period up to 12 months, it becomes a short term capital asset. Now, to determine the long term capital asset, the date of acquisition and the date of sale both are to be included in the duration. Right. There are another situation wherein unlisted equity shares or immovable property, if they are held for a period in excess of 24 months, it will become a long term asset. If unlisted equities, unlisted shares, or immovable property are held for a period maximum up to 24 months, it becomes a short term asset. And any gains that I arrive on selling of those items, that will become my short term capital asset. Now, here I would like to clarify one fact that whenever I am saying a unlisted equity, that does not only mean shares of a private limited company or a public limited company listed, which is not listed in any recognized stock exchanges. Any shares which are listed outside India, that also falls under the ambit of unlisted equity shares. Why? Because if we see at the definition in the Income Tax Act, listed equity share means any equity share that is listed in any recognized stock exchanges in India. Therefore, if you are selling any shares which is listed in NASDAQ, even though it is actually listed, since NASDAQ is not a recognized stock exchange in India, it will assume the characteristics of a unlisted equity. Now let's talk about taxation rate, right? Usually, the short-term capital gains are taxed at the slab rate, right? So, if a person is being taxed at 30% marginal slab rate, the highest slab rate possible, any short-term capital gains will be taxed at that particular rate. However, there are certain exceptions to it. For example, in case I am selling of a listed equity which is giving me a short-term capital gains. In that case, 15% rate of tax will be applicable, right? If it is a equity mutual fund, then also special rate of 15% will be applicable as tax rate. Now let's take a look at long-term capital asset. Any asset which is not a short-term asset is to be treated as long-term asset. Now we have at length discussed what should be the holding period for a long-term capital asset, right? Now the usual tax rate for long-term capital asset is 20%. However, again there is a special case wherein a lesser rate of tax is prescribed. That special case is for equity and equity-oriented mutual fund. In case a equity oriented mutual fund is being sold or an equity mutual fund is being sold, in that case, any gains that I am making beyond 1 lakh rupees, that becomes taxable at the rate of 10%. For example, let's say I have a share of XYZ company, right, which is listed. Now, I am selling the XYZ shares at the rate for 5 lakh rupees, right? However, I have purchased the shares of XYZ when its price was 2 lakhs, right? So I am making a gain of 3 lakh rupees. Now, out of this 3 lakh rupees, I will be given a relief of 1 lakh. I will be given a deduction of 1 lakh. Therefore, my taxable long-term capital gains will become only 2 lakh rupees, right? On this 2 lakh rupees, I need to pay tax at the rate of 10%, which will give me a tax of 20,000 rupees. Right. Another special case is there, that is 10% rate is also applicable for listed securities except for equity or equity mutual fund. Right. These are usually the bonds or the debentures. Now, listed debenture has a unique characteristic that it can have two rates of taxation. One rate of taxation is 20% with indexation. Another rate is 10% without indexation. Now let's try to understand what is indexation so that this point becomes a little bit clearer. Indexation is a special mechanism which actually uplifts the cost of an asset which was acquired long time back. Now, if we put it simply, if let's say I have purchased a house 10 years back, which costed me, let's say, 10 lakh rupees, and after 10 lakh rupees in this year, I'm selling off that property, right? And it is fetching me 70 lakh rupees, right? Now, the price point of 10 years back is not to be equated with today's standard because of inflation and a lot of other things. Therefore, if I just simply go ahead and reduce cost of acquisition, that is 10 lakh rupees, from the selling price, that would give me a 60 lakh rupees of capital gains, which is unreasonable because in the period of 10 years, multiple things has happened, right? The prices of items have gone up multifolds. Therefore, this phenomena has been recognized by the income tax department and the government, and they give us a mechanism to uplift the cost to today's standard, right? For that, each and every year, income tax department issues a cost inflation index number, which relates to indexation point of each years. Using those indexation points, we can equate the yesteryear's purchase price to today's purchase price, right? So, for example, the indexation point given for 2001 is 100, right? And for 22-23, the indexation point that was given was 331. Therefore, if I have made a purchase of 10 lakh rupees in a property in 2001 2002 financial year, in that case, the price will be increased to 33 lakhs 10,000 rupees for 22-23. Therefore, the long term asset enjoys a benefit of indexation. Now, having said that, let's try to understand what are the tax saving opportunities of capital gains. Now, tax saving opportunity is only given when it is a long term capital asset. Normally, long term capital asset long term gains can be saved using three mechanisms. Number one, Section 54 benefit, 54F benefit, and 54EC benefit. Now, Section 54 actually tells you to sell off a house property and invest the gain amount in purchase or construct a, another property. If you do that within a specified time, in that case, whatever gains that you are making, that will become exempted in your hand. Section 54F tells you to sell off any long term asset other than immovable property and invest the entire sum of money into a newly uh, acquired house property. Invest the entire sum to acquire a new house property. You can buy it or you can construct it, and by doing so, you can get an exemption on the capital gains amount. Now, the key difference between Section 54 and 54F is under Section 54, you need to invest only the gains amount to get the exemption. However, under Section 54F, if you want the entire gains to be exempted, you need to invest the entire sum of money. In short, the deduction or exemption under Section 54F is directly linked with the sale proceeds. If we try to tackle this with an example, let's say I have sold a share, right? I have sold a share worth rupees 10 lakh rupees, right? And on that 10 lakh rupees, there is a gain of uh, 2 lakh rupees. Now, if I invest the entire 10 lakh rupees, my entire gain of 2 lakh rupees will be exempted. If I invest, let's say 5 lakh rupees, in that case, proportionate gains will be taxable in my hand, and remaining portion will be exempted in my hand. Since I have invested only 50% of the sale proceeds, only 50% of the gain amount will be exempted in my hand. Remaining 1 lakh rupees will be taxable in my hand. Now, Section 54EC also gives me an alternate opportunity to save the taxes of long term capital gains. Under Section 54AC, I can sell off a house property and invest the gains in specific bonds for a lock in period of 5 years. and uh, it will be exempted. Now, maximum allowed amount is 50 lakh rupees, and you need to invest this sum within a period of 6 months from the transfer. Uh, from the transfer, right? So there are certain bonds. These bonds are called Section 54 EC bonds. For example, NHAI bonds are there, RECL bonds are there, Railway Finance Corporation bonds are also there. So there are a listed few bonds which falls under the ambit of Section 54 EC. Therefore, if you have those sort of capital gains which arises on sale of a particular house property, in that case you can take Section 54 EC. Now, for any reason, if you are unable to make the investment into a house property, or any reason you are not able to invest the sum within a period of 6 months into Section 54 EC bond, there is a opportunity available for you to still save the money. That is called capital gain saving scheme. You can deposit the gain amount in capital gain saving scheme, and from there you can withdraw the sum of money and invest the sum in uh, proper class of asset so that you can get the exemption. The time frame for Section 54 is, in case if you are purchasing a house property, it must be done within a period of 2 years from the date of sale. If you are constructing a house property, then you need to construct the house property within a period of 3 years from the date of sale, right? However, if you have acquired a house property earlier, then selling another house property, in that case, you can go back maximum 1 years, right? The same principle shall apply for Section 54F as well. Now, let's try to understand the capital gains in case of sale of house. Now, if the house property that you are selling it off is held for a period more than 24 months, it will be treated as long-term capital asset, and any gains that you are making on sale of that house property, that will be a long-term capital gains. Now, long-term capital gains, as this is, a indexation benefit will be given on the purchase price of that house property. Furthermore, if you have made any sort of investment on improvement of that house property, maybe you have done roofing of the house property, right? You have teared down its walls and erected a new wall, or you have done some crucial job so that the value of the house property or the life of the house property has been increased. Those improvement costs can also be taken, and if they are more than 24 years, or rather 24 months old, in that case indexation benefit can also be applied for them as well. Further, if you are selling this house property, there is a chance you have paid some sort of brokerage, or if you have incurred some sort of selling expenses. Those expenses can also be taken as deduction while arriving at the capital gains. Right? And finally, after all these deductions and calculation, whatever amount you are left with, that will be your long-term capital gains. And if you plan your investment correctly, you can take advantage of Section 54 or 54 EC. Right? Now, see, till now we have been talking about long-term capital gains. Now let's try to understand something about capital losses as well. Capital losses, as its name implies, is something which happens when you sell off the asset at a lesser price than what you have paid to acquire it, right? So in case of capital losses, there are two types of losses again. One is short term capital loss, one is long term capital loss. Now, the long term capital loss has a special stature. Long term capital loss can only be set off with long term capital gains. It cannot be set off with short term capital gains. Whereas short term loss can be offset with short term capital gains as well as long term capital gains. Right? Now, if you are incurring short term capital loss or long term capital loss, it is imperative that you should be filing your income tax return within the due date. Why? Because if you are filing the income tax return with the due date which has a loss, you can carry forward that loss up till 8 years. And in those 8 years, any gains of similar nature arises, in that case, you will be able to set off the gain with the carry forward losses. However, this carry forward is only possible if you file the income tax return within the due date. Therefore, if you are in a loss position, please be mindful to file your income tax return within the due date, which is going to be 31st of July. Now, let's talk about advanced tax implication. Because uh, if you are if you are unable to invest the money into appropriate fund or appropriate class of asset, there will be a liability of tax payment coming in your hand, right? And as per the Income Tax Act, any person who has a outstanding tax liability after setting of TDS and everything, TDS, Section 90 relief and all, TCS, that person is supposed to pay advance taxes, right? Now, advance taxes need to be paid in a quarter-wise manner. Uh, the due date for making advance tax payment is 15th of June, September, December, and March during the financial year, right? If you are not paying advance taxes, in that case, interest under Section 234B and 234C may be applicable for you, and the amount that you need to pay for advance taxes for each of the quarter are 15%, 45%, 75%, and 100% of the due tax amount, right? So again, if the sale is happening on the third quarter, right, then be mindful to pay advance taxes before 15th of December to stop incurring the interest component. Now, uh, right now we are at the end of our webinar. Now we will be taking up some question analysis. Right. So one question is arising. Uh, Manoj has inherited money as NRI from sale of our parents' house. How do I avoid capital gains taxes? Right. So if you are a non-resident person and if you have sold off your parents' home, in that case, the options that are left with you are Section 54 EC and Section 54. Now, in that case, you need to invest the money into a new house property, or you can invest the sum of money into Section 54 EC bonds. That too, if you are going through Section 54 EC route, the amount must be invested within a period of 6 months from the date of sale. Otherwise, you need to, invest the money into purchase of or construction of a house property. Right. So dividend stripping and bonus stripping. So dividend stripping actually happens if you plan your investment in such a way, whenever the dividend is given to you, uh, that becomes, you sell it off and later point of time you reacquire that. However, dividend stripping and bonus stripping became less relevant from the point the dividend and long-term capital gains on listed equity share became taxable. So therefore, dividend stripping does not really work anymore, because at the earlier point of time, dividend whatever you have earned, that was not taxable. You get the dividend, you purchase the shares to get the dividend, then you sell off the shares, so you need not pay any dividend taxes, right? However, that is not the situation here. You are paying taxes on the dividend, therefore it does not really have any standing at this point of time. And again, bonus shares, the long-term capital gains became taxable. The Section 1038 has been abolished as well as Section 1034. Therefore, it does not really have any standing at this point of time. Right. We are going to wait for another 5 minutes. If we get any more question in that 5 minutes, we are going to continue. Otherwise, we are going to stop. Thank you. All right. So grandfathering clause in case of inheritance will remain same as normal shares. However, the date of acquisition shall be of the date in which the original person has purchased those shares. For example, your father may have purchased those shares in 2002, right? And you have inherited those shares on, let's say, 2019. In that case, your cost of acquisition, your date of acquisition shall be the same as your father's date of acquisition, that is 2002. And we shall also apply the grandfathering clause, that is value as on 31st of January 2018, and we are going to compare those three values: the sale value, the 31st January value, and the cost of acquisition value, and get to know what will be the relevant cost of acquisition. In case you are inheriting any asset, in that case, the date of acquisition in your hand shall be same as the date of acquisition in the hand of the original buyer. In case equity shares are being inherited, there is no question for grandfathering per se. Right, Abhishek. So, if you are talking about your uh, mutual funds gains or losses, in that case, you can download the mutual fund gain or losses using KFintech website or CAM's website. They give you an option to generate consolidated capital gains and loss statement in their respective websites, KFintech and CAMS, in respect of mutual fund units. For equity shares, you need to download that from your broker account. Right. So we are actually at the end of our session. I would like to thank you all for attending this webinar. I hope you have taken some understanding of capital gains with you and you will be able to put them to good use in the upcoming tax return filing season. Thanks from me and Rahul, and thanks for joining us. Have a great day. Bye bye.